Now we're sensitive to interest rates in the sense that like maybe investors don't want to invest and they want to hold on longer to their money or that type of thing. But as far as the market itself, we're not very correlated to interest rates. I will say though, I don't want to sit here and sound like there's no risk. Things move really, really quickly in the online business space. They aren't apartment buildings or physical objects. I mean, sometimes you're selling physical products, but like we can move much quicker in obviously technology is moving at a very rapid rate. So we need operators that have been at this for a long time that can adapt quickly and that aren't just a one trick pony. So there's a lot of people out there that have made a good amount of money online, but they would not be able to go out and recreate that. It might have just been a flash in the pan. So that is one risk with the online businesses in general is just the rapid rate of change in technology.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Kyle Kuderewski. Kyle is the operations manager at WebStreet, an investment platform allowing people to passively invest in online businesses and digital assets. Kyle is an engineer turned investor entrepreneur. He's leveraged his attention to detail and knowledge of systems to create a well-oiled operation at WebStreet as they scale. And in just a minute, we're going to speak with Kyle Kuderewski about investing passively in cash-flowing digital assets. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Kyle Kuderewski. Welcome to CREPN Radio.
Hey, Dan, how are you doing? Thanks for having me.
I'm doing well, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure, sounds good. So, like you said, I'm an engineer, kind of turned entrepreneur, investor. I went to engineering school and got in the corporate America world. Treated me well for many years, gave me a good start to life. But I knew I had an entrepreneurial itch that I wanted to scratch. And my first kind of step away from corporate America was into real estate investing. So I still am very active in the real estate world. But I also joined a startup, which is WebStreet, which I think we'll talk a good bit about today. And that's in the investing world as well, kind of in the digital real estate form. So we invest in websites and applications, SaaS softwares, Amazon storefronts, that type of thing. And so it's something that I've been really passionate about, and I've been out for about the last 3 or 4 years.
Awesome. Well, maybe the best place to start is kind of to define what are digital assets.
Yeah. So it's a great question because there's many, many different types. Basically, if you think about, you're listening to this, listeners are listening to this on some type of device. Maybe they're watching on YouTube. Really, anytime you're in front of the screen, somebody's getting paid, whether it's you paying them with a subscription or advertising or any other type of way. Somebody's generally getting paid. So the main monetizations or types that I like to talk about or that we invest in are content sites. So these can be review sites, they can be blogs, they can be, just generic websites. So you're getting paid for affiliate links or you're getting paid for display ads. This has been around for quite a while. There's also Amazon storefront. So everybody or most everybody likes to shop on Amazon. There's fulfilled by Amazon. So they're doing all the legwork and you're just sourcing the material or the product to them. That's called Amazon FBA. And then something that we're heavily investing in right now is SaaS, so software as a service. So we're talking on Zoom. That's obviously a huge recurring revenue, but all the way down to games on your phone or calendar applications, any of these services that you pay for that renew monthly or renew annually, those are what's known as software as a service. And then there's some other smaller ones as well. Amazon Kindle, so Kindle Direct Publishing has really changed the game for people in the publishing space. Um, so those are the big monetizations that we invest in. And then there's also agencies. So marketing agencies, SEO agencies, any type of agency that helps with these digital assets is something that we're also involved with.
So are these investments, are these direct into the creator, or are these more of like through the advertising platform uh, where you can glean from the advertiser? Help me understand more. I guess
Yeah.
you've explained what the digital assets are, but I guess I'm trying to understand where the investment opportunity lies.
Yeah, so we have a fund model. If you look at, we didn't create this model. We simply implemented it for digital assets. If you look at products where you're investing fractionally in real estate, right? There's a bunch out there, Roofstock, Fundrise, Yield Street. There's also ways to invest in art or wine or whiskey or sneakers, that type of thing. So it's a fractional investment model. So you're investing in these assets, and I named about 5 or 6 different types of those assets. Each of our fund has a different allocation. So we have some that are SaaS heavy, we have some that are Amazon heavy. So you're investing in a fund in an SPV in a fractional ownership model, and then you get a share of the profits every quarter. And then eventually, we exit those businesses, and you get your share of the profit on those as well. So that's the model, and we can get into the details if you want on how it breaks down and all of that. But on the surface, that's a way to do it. It's a cash flow play, right? Right? It's a little different than a piece of art. And I don't say that to say art's a bad investment. It's definitely, there's a lot of, you can make a lot of money out there, but it's not going to, a piece of art isn't making cash every month, right? It's not a cash flow play. You're waiting on that to appreciate. The type of businesses that you're investing with us are, hopefully they appreciate and the businesses are growing, but they're also cash flowing from day one. So that's what makes it a little bit unique.
Got it. So as a fund model, you're seeking investors to invest in the fund, and then the fund then seeks out opportunities within the prospectus or whatever you've defined your range of appetite in
That's exactly
return.
right. Yeah,
Okay.
that's exactly right. Yeah. So we'll lay out an allocation. Each fund usually has, we call them operators. So if you think of somebody that's buying multifamily apartments or whatever, or even commercial real estate, you have somebody who's like operating, right? Maybe they're going in and renovating, they're doing marketing, they're the ones running the piece of real estate. We do the same thing with these type of businesses. So we go out and find the best online business operators, whether those are engineers or marketers, whatever is needed to grow these businesses, and we pair investors with them and with the assets, and we actually purchase them in the LLC that you invest in. So you're on the cap table, and yeah, it's a fractional ownership model.
So when you invest, I mean the SaaS kind of makes sense to me. I mean, it's essentially you've got. I'm assuming are these more like startups or these like existing mature businesses?
Yeah, so some are there's a range, and there's we give a risk, kind of a risk score, and you have to decide for yourself what you want to invest in, and definitely do your research. But to give you an idea of what we're talking about, some of these are SaaS businesses. Actually, let me take a step back. So each operator has a different strategy, right? So some of them are B2B, some of them are B2C, some of them go after kind of businesses maybe that were in the Y Combinator startup universe that maybe ran out of cash or just didn't quite make it. Um, So there's many different types of SaaS businesses. To give you an idea of the range, we recently acquired two different SaaS businesses. One of them was around $2.5 million and one was 1.3. So those are the kind of the ranges that we're investing in right now. Each of our funds is anywhere from $5 to $8 million, and that would have maybe 50 to 75 investors. I know numbers are kind of hard if you're just listening, and you don't have the website in front of you, but $5 to $8 million usually gets you 6 to 8 businesses across a couple different monetizations. So it might be a couple SaaS businesses, a couple Amazon businesses, and then a couple content sites or something like that.
So when you say businesses, are you 100% acquiring the business?
Correct. That's right.
Okay. So this is not like just a fractional ownership of the business that you're investing, but you are wholly uh, owning that business. So when you do that, do the operators stay in place, or then do you um, put in your own operators?
We bring our own operators on board. So, and then in the SPV, you have the operators, you have the investors, and then you have us. Although we don't actually own, where we just facilitate all of that, right? So it's operators and investors. Sometimes these operators have their own teams that they bring in. Sometimes they'll need to hire people to help run the businesses. Sometimes they're using freelance work. Um, but they're experts. We kind of vet all of that, right? So when the operators go find the businesses, we'll say, we'll do in-depth vetting. How do you think you can grow this business? Why is it attractive? And then, we have ultimate veto power on whether they can purchase the businesses or not, whether they can be in our fund or not.
Okay. So my guess is I'm just kind of thinking this through. It's, I mean, very similar to like a real estate syndication kind of
Very
model.
much, very much. I
So
probably should have started there. Yeah.
no, that's, I mean, but it's interesting to me how many business models basically follow that.
Hmm.
Uh, Trying to identify the undervalued asset, having a plan on how you can increase the value, make it bigger, better than what it currently is, and then some sort of an exit strategy.
That's
So,
exactly it. I think you'll find this interesting. So sorry to cut you off there. I still do real estate syndications all the time. I think it's an excellent model. This is just another way for people to diversify in digital assets because people, realize how much time you spend in front of the screen. Um, why would you not want a piece of that action? And in addition to real estate and whatever else you're invested in, S&P 500, et cetera. So that's kind of why we built it, which is why I wanted to jump in there. I think it's important.
got it. So I think that the primary difference between a physical asset like real estate and a digital asset is that if the operator somehow misses the mark in the real estate's still there, presumably. I mean, I think there's a pretty high chance of that. How, tell me about the the digital asset again. I'm kind of a slow ski when it comes to the digital world. I mean, I understand how to click buttons and stuff, but the models are not always clear to me how they work. Um, if you like software as a service, um, that's such a broad thing, but I guess it is the fundamental uh, piece to that there's some sort of recurring revenue stream and that, there's a subscriber model.
Yes. So I do want to address what you were saying, and I know you talk about this all the time on your show, is risks. So there's certainly a lot of risks in digital assets, and they're a bit different than real estate, like you were saying. So we can jump into those. It's a really good point on SaaS. I actually talk about this all the time on podcasts and within our own team. There's so many different types of software as a service, and people just use it as a buzzword. We really need to niche down within that. So but you're spot on. The fundamental piece that makes software as a service is the recurring revenue, and other than being a piece of software, that's it. It's the recurring revenue, which is what makes it really appealing to people. You can kind of project your churn rate. There's certain things you can do to grow it. And unlike a product that might be more seasonal or whatever, it's more predictable. And it's what we like to use in quotations as the word sticky. Usually when people subscribe to these things, they stay subscribed, either on purpose or on accident, or maybe they'll change to an annual plan or whatever, but it's a sticky model.
So with that, I mean, in real estate, there are physical limitations to a marketplace. Um, that it's easy to determine if something's, I shouldn't say it's easy, but it's visible. I mean, you can see if the market's overbuilt, or if maybe there's not a need in a particular area, kind of thing, or you can kind of gauge the opportunity there. Uh, so in a digital world, uh, you have a service, you buy the service, you expect to grow the service. How does one discern between the opportunity to, grow a service versus the unlimited opportunity for others out there to start and create something similar, newer, bigger, faster than what you're investing in? Or is
Yeah. So
that
you, Yeah, I mean, you hit on a lot of really good things there. It's tough, I think, because I have to speak in generalities,
sure?
because of the different types of operators and the different types of businesses. That's something you're always looking at, right? Like, what is your moat? Um, Whether that's for real estate or another asset class, or what we're talking about here today, what does the moat look like, and what's the barrier to entries? So, um, it, I'll say in general. If you look at softwares like Zoom, and this is much, much larger than what we're dealing with, because the company has become so large and the tech stack and everything that it's built on is let's just say antiquated, it's very hard for companies of that size to adapt, and move quickly. And so they're a bit ingrained in our workflows, but there's many other services, video services out there now that are much better than Zoom, or better than, so as you become this behemoth, it's much harder to adapt and reroute the ship. So I just wanted to address that what you're saying is makes a ton of sense. And now on the flip side, because of the no code technologies and AI and everything that's out there now, it's also much easier for companies to come in and kind of disrupt. So that's something you're always looking at. What's the barrier to entries? So I'll be very clear with one example. The piece of software we bought for about 1.3 million, about a month or two ago. It's a type of scheduling tool, but it's very specific for the healthcare industry, and it has all types of certifications that take years to get. Um, I can't remember the specific certifications, but those are huge barrier to entries that would stop somebody else from coming in. So those are the type of things we're looking for. And then, like, what are they doing wrong? Are they not marketing well? Do they only have one large customer, and then a bunch of small ones? Is there, like, what does the potential customer base look like? And so these are all things that we're constantly evaluating on our deal flow. Does that make sense?
Yeah, absolutely. And I appreciate you kind of like, giving some sort of an example and just a specific industry kind of
Right.
thing, because I think um, and I know there are tons of apps that I'm, engaging daily, uh, many of which I don't even realize are an app, based on just the way they present themselves on my screen, and whether it be an employer or somebody, client that's presenting them to me, and it's just they're everywhere.
Sure. And
Uh,
another clear example on that would be, like, if you're not buying something on Amazon, say you're buying it off another storefront, a private storefront, it's probably built on a Shopify um, application, right? That's super common. It's the largest kind of marketplace. And if you want to go start your own store today, you're probably going to build a Shopify store. What most people don't know is that on top of Shopify, there's a whole marketplace of Shopify apps. So we have an operator that we work with that specializes in building those applications on top of Shopify stores. So you would never even know as a customer that you're interacting with a whole nother application. Um, Whether it's one of the discount things, or it's something to do with the way the shopping cart works or whatever, you would never know that. But they're, to your point, they're kind of everywhere. You're always interacting with them.
right. And I think what's encouraging to me in what we're speaking about is more of the B2B opportunity as opposed to the B2C. I feel like sometimes the B2C, I don't want to say it's saturated, but it just seems like there's a lot of noise as opposed to a tool kind of thing.
Yeah, I would agree
Um,
with that.
the scheduling example you mentioned that has certifications and that I'm going, okay, now that to me is something that makes complete sense. And a lot of times I feel like the world is full of problems that need solutions. There's also a lot of solutions for a problem that hasn't been recognized yet. And I think a lot of times I'm more um, of the nature. My thinking is to create a solution to a problem that doesn't exist, kind of thing. And when I start talking to people, they're like, "What's the problem?"
Yeah, that's funny.
So
I agree with you.
the so and I'm assuming that your team and the experts you have on board and the horses you've or the jockeys you've chosen to work with
Yeah.
have that kind of skill set to identify and drill down and to recognize how big the opportunity is and what how to get there. Is that
They
fair?
do. No, it's definitely fair, and it's a really good point. I usually hit on it earlier, but we we have a unique advantage there. So we started Web Street. We started as a sister company to a brokerage called Empire Flippers. And Empire Flippers, you may, if you're familiar with online business brokerages, there's many of them out there. There's Empire Flippers, there's Quiet Light, there's Flippa, there's Acquire.com. And those are marketplaces where if Kyle builds a website and he wants to sell it, or a SaaS application and Darren's looking to buy one, you might find my site for sale. It's just a brokerage, right? But Empire Flippers is a huge was the biggest player in the space, maybe still is, and they have over 500 million, so have $1 billion in dollars in deals brokered over the last decade plus. The reason that's important is that's a huge network of people that we know that have bought and sold and scaled multiple websites. So we have a nice pool of operators that we know oftentimes in person. We know them from conferences. We know them from our history with Empire Flippers, that these are the best in the game at building and scaling and selling websites. And so we go partner with them and bring investors the opportunity to work with them. Does that mean it's foolproof? Does it mean all of their, every time they step up to the plate, it's a home run? Of course not. But it's a really, really good starting point and something that's been advantageous for us.
Okay. So help me understand the kind of the strategy when you're looking for a prospective, um, whether it be I guess a digital asset to invest in. Is there any kind of a uh, like an amount of time you want to see somebody have invested in it, or can it be more of a just a specific recognition of the opportunity based on the market? Because this thing is so wide open as far as the different opportunities. At least that's where my mind's going. Is that there's unlimited number of opportunities.
Yeah,
I think
certainly. And so it's a really good question. It's also really broad, and I don't want to ramble. I'd say I'll tell you some of the things we look at, and you could take them as a positive or negative. Um, so here's some of the things you would look at. Of course, you want to look at niche, right? Like we're not going to go out and get a hand sanitizer business or a COVID mask business at this point. That was a flash in the pan. So you want to look at what the product they're selling is. Is it an evergreen product? Does it have seasonality? That could be good or bad. But then you compare that with the P&Ls. You see, is this business growing or is it declining? Generally, there can be good deals out there on businesses that are declining, but that's not something that we want to invest in because we're dealing with investor money, and that's our North Star, right? Is return. So we're not going to jump on these riskier type businesses. Is this a business that's super dependent on the founder? In other words, has he been running it for 10 plus years, and by that business changing hands, it may just fall apart, or maybe it's super stable because of the time he's put into it. So certain businesses are really, really founder dependent, and some aren't. So that's something you got to evaluate. If you're in the product business, does this product have 100 SKUs and only one of them is keeping it afloat? Or is it really focused with three SKUs that have a lot of, that there's buffer if one of them starts to decline. When you're looking at SaaS, so like what is the tech stack that it's built on? Is it Ruby on Rails? Is this some old antiquated? Is this a no-code technology? Is AI going to be a risk of just completely replacing this business? So those are a lot of the things we look at, and many, many more. Um, that are that are risks. Sometimes it can be a positive, sometimes it's a negative, and it also depends on what our operator that we're the guy that's going to be running the business when we buy it. What is his plan? Is his plan to market this business better? Is it to add new products? Is it to pretty up the website and reinvent the stack? Does his plan match the opportunity that the business has? Because a lot of those things I named could be positives or could be negatives, but it just depends what's the strategy. So again, those are some generalities, but we've got 50 plus assets under management already. And so it's kind of hard for me to just give specifics as if I had two or three assets.
No, I get it. I get it. I'm just sitting here kind of processing in my head as you were talking there. It dawned on me that even if something's a digital asset, there are people behind the digital asset that are doing the work to create the product
Yep.
to for the people to engage and customers to buy the product or the service or whatever. So in that aspect, I mean, essentially it's buying a business,
Yeah.
whether you're a lawn service or a plumbing business, air conditioner, repair or whatever. I mean, they all have basically common elements. You have people that do the work, you have a revenue stream, and you have expenses. And goal one is to increase the gap between revenue and expenses. And and then I guess the other side of this is what's an exit strategy? Do you typically have a horizon set on when you expect to exit something, or is that more of a you mentioned that cash flow is the primary goal, but is there a uh, when someone's investing in the fund, is there a an expectation that you will be entering and exiting, going full cycle on these different assets, or are you just kind of building up a kind of a Berkshire Hathaway model to where you just have, a stable of assets?
Yeah, so you hit on a couple good things there. Definitely still a people business, even though behind screens, it's a people business. I mean, one of our operators, several of them, but one is very clear about this. So we always talk about like, what's your first 90 days look like, right? What are you doing as soon as these businesses are acquired? And one of them, he was talking to me about this recently on an interview similar to this. And it was like, I'm going to talk to the customers. I'm going, whether it's focus groups, whether it's surveys, whether it's getting on the phone and just calling them. So these are still people oriented businesses. And I think that's a really good early strategy to figure out what's working and what's not. Now, as far as the model, um, I did hit on the cash flow. That's a really something that's very unique and important to our investors, important to our model. But the exits are as well. And we tried to make the model unique for diversification. So our exits generally happen in the 2 to 4 year range. So it's not a super short hold period. It is illiquid during that time. Um, but it's not as long, a really long play, a 10, 15, 20 year play either. So our exits generally happen in the 2 to 4 year range. We do put a range on it for a reason because we don't want to be pigeonholed into a corner or however you want to say it. If the market's bad at that 3 year mark, um, and we think it's going to turn around or whatever the case is, we don't want to be forced to sell the businesses at a loss. We want to do what's best for our investors. Or maybe the business is double in just over a year. Maybe we want to sell early and go ahead and get those profits. So 2 to 4 year range is generally what we say. It's the same profit split. Investors get 66% of all profits. So that's every quarter they're paid out, and then 66% of the profits on the sale of the business as well. We've been at this model for about 3 years now, and we just started doing our first exits. I think we sold a couple businesses last week. So we're right on track for what our model shows. But it could be a little shorter, could be a little longer.
Got it. And how sensitive is this marketplace to, things like interest rates? Because it doesn't sound like you're engaging in any kind of leverage
No.
with financing.
Yeah, that's a good question as well. So not very sensitive to interest rates. Uh which we think is another good thing. Yeah, we don't do any debt. Now we're sensitive to interest rates in the sense that like maybe investors don't want to invest and they want to hold on longer to their money or that type of thing. But as far as the market itself, we're not very correlated to interest rates. I will say though, I don't want to sit here and sound like there's no risk. Things move really, really quickly in the online business space. They aren't apartment buildings or physical objects. I mean, sometimes you're selling physical products, but like we can move much quicker in obviously technology is moving at a very rapid rate. So we need operators that have been at this for a long time that can adapt quickly and that aren't just a one trick pony. So there's a lot of people out there that have made a good amount of money online, but they would not be able to go out and recreate that. It might have just been a flash in the pan. So that is one risk with the online businesses in general is just the rapid rate of change in technology.
Got it. For investors, I'm assuming requirement accredited investors, is that hold true or
Yeah, that's correct.
okay? And what's a minimum investment that you typically seek for your funds?
Generally, it changes sometimes fund to fund depending on what we're trying to raise, but generally we're in the 50 to $60,000 minimum range, and that gets you access to a $5 to $8 million fund, which will get you access to 6 to 8 businesses depending on the just depending. But yeah, 60,000, 50, $60,000 minimum is generally and usually people will come in at that amount their first time, or maybe 100, test the model out, make sure they like us, like the everything about it, and then they'll come in for much higher amounts.
So, from a prospectus standpoint, is there any kind of a projected return, or is there a for a
Yeah,
fund?
yeah, 20%. That's after the exits of the businesses. That's what we're on track for. That's what we projected. Our basic financial model, which we can share publicly, is you have a portfolio that has 5 businesses. Say you invested $100,000, you got 5 businesses. One of them increases by 50%. 3 of them more or less stay flat, plus or minus 10%, and then one of them just goes completely to crap. Under that model, you would come out at the 20% at the end of all those businesses being sold, and that model is built on a 3-year range. Generally, you're getting about 2 to 3% every quarter, 2 to 4% really. But if you get 3% per quarter, that's 12% on the year, over 3 years, and then say the business increases in value, that's how you hit the 20%
Got it. So the 20% over the life of the hold.
of the
Is that
fund.
right?
Yep, exactly. Yep.
Got it. Got it. All right. Well, if you're I'm trying to think of something that I should have asked you that I didn't. Because to me it took me a little bit, but I think as I got into it, I understood the buying a business, no leverage, and then trying to improve the business, and then seeking an exit is pretty much. I mean, it mirrors a lot of what I've come to recognize and identify with real estate.
Yeah, that's
And
exactly right. And
so,
I can go really down the technical rabbit hole, and I try to zoom out. One of our biggest hurdles is kind of explaining the model, because it is a lot of it is well, it's all technology based. It's hard to see, hard to visualize. But yeah, I think you understood it well there.
got it. Well, if we could, Kyle, I'd like to shift gears here for a second then.
All right.
As I explained before we started, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. Could be your clients, investors, um, the digital world. I don't know what risk are that you identify, but I'd like to see, if you can identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Kyle Kuderewski, what is the biggest risk?
Yeah, I think this one for me, I'm thinking about the investing risks all the time and whatnot, but I have to zoom out and I like to go on a personal level here. And this is kind of why I got out of more of a corporate role and what kind of led me down this investing path and this entrepreneurial path. So to me, I think the biggest risk is becoming too focused on immediate tasks and losing sight of long-term strategic goals. So it's easy to get caught up in day-to-day demands and miss those opportunities for innovation, for growth. And what I mean by that is like, what am I doing day in and day out at my previous engineering job? Is that getting me where I want to be long term with the way my life's built? If I want to be able to work remote, or if I want to spend more time with family, or whatever the case is, I need to craft a life around that. So you talked about mitigating it. This is actually written here on my desk. I schedule regular big check in, big picture like review sessions where I assess my progress against my goals and identify where I need to adjust. And then the other way I mitigate that is I build accountability by sharing these goals with a colleague or a mentor. Mentors are a huge tool I use so that they can provide feedback and tell me like, yo, you're getting out of line here. This is not leading you toward the goals you want. You're too focused on the day to day, whatever the case may be. So to me, that's a really big risk. And you can lose tons and tons of time, years and years of your life if you're not paying attention to those big picture goals.
Yeah, true. Kyle, where can listeners go if they'd like to learn more or connect with you?
Sure. I'm really active on LinkedIn. My last name's a bit hard to spell, probably be in the show notes here. So LinkedIn is good. Also, Kyle at webstreet.co, not .com, .co. That's my email. I do respond to all emails on there. So feel free to reach out if you want to talk investing, if you want to talk entrepreneurship. I love connecting with podcast listeners. I've made quite a few cool relationships there. So LinkedIn or email. If you just want to learn more about WebStreet, it's webstreet.co as well. There's tons of information on there. And yeah, I appreciate the time, man.
Awesome. Well, Kyle Kuderewski, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
Sounds good. Thanks, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.